In most states, a driver with a spotless record and poor credit pays more than a driver with a serious violation and excellent credit. Not as a loophole, not as an error, as the filed approved price. The document that sets it is public. Anyone can look it up by number. The part that does the work has been sealed. Start with what the product says it is. Insurance is risk transfer. You pay a premium, the insurer carries the loss, and the price is supposed to track the risk you bring. That is the whole logic, and it is a sound one. Every quote form in America opens the same way. Accidents, violations, claims in the last 5 years, annual mileage, years licensed, driving questions in that order. Then the advertising closes the loop. Safe driver discounts, accident forgiveness, telematics apps that watch the brake pedal and promise to reward a gentle foot. So, the belief that a premium is the price of a driving record is not naive. It is the product's own description of itself, repeated on every form and in every commercial. It is what the industry spends its advertising budget teaching. It is also, in most of the country, not how the number is built. There is another variable on that form. It is not on the form. The National Association of Insurance Commissioners, the regulator's own body, reports that roughly 95% of auto insurers use a credit-based insurance score in states where it is permitted, not a fringe practice. Effectively, the market. So what is the thing they are using? A credit-based insurance score is built from the same credit file as a lending score, the same file. The Federal Trade Commission is explicit. The models are developed in the same manner as credit scores generally, and many of the same types of information are used. What changes is the question, the weighting, and the scale. A lending score asks whether a borrower will repay. An insurance score asks whether a policyholder will file a claim. The variables are reweighted for that second question, and the output runs on a different range, roughly 100 to 999, not the 300 to 850 most people recognize. Same file, different question, separate product, sold separately. So, how much does it move the price? And this is where the trail stops. The rate plan is a public document, filed with the state, reviewed, and approved before a single policy is written. Texas holds tens of thousands of them, searchable, with docket numbers. Docket Heart 134785946. TX Auto Prevail Credit Score. Reorder, Red Point County Mutual, filed December 30th, 2025. Docket Seal-In 134739159. TX RIC Credit Reorder, Root Insurance November 14th. The titles name the variable, the scoring model inside them is filed too, and then it is sealed. Washington State's insurance code says it plainly. Revised Code of Washington, 48.19.035. Scoring model information shall be withheld from public inspection and kept confidential by the Commissioner. Shall be considered trade secrets. Not withheld by an insurer. Withheld by the regulator on the insurer's behalf, because the statute instructs it. Texas says the same thing more quietly. Its public filing search warns of what the results will not show. Filings that are company marked confidential. So the file is public and the chapter that matters is locked. You can cite the docket number. You cannot read the model, which leaves one way to see the weight, from the outside in the outcome. Congress ordered the Federal Trade Commission to study exactly this. The FTC obtained actual policy data and modeled what happens to premiums when credit-based insurance scores are used against what would happen if they were not. Start with the total. 59% of consumers saw their premiums fall. 41% saw them rise. And the net effect on the money collected, 0.0%. That is the mechanism. The score does not create revenue. It does not make insurance cheaper or more expensive. It moves the same pile. It is a redistribution engine, and its entire output is the answer to one question: who pays? Which leaves only the who. The FTC broke the same table down by group. Average predicted risk relative to no score at all. For African American consumers, up 10.0%. For Hispanic consumers, up 4.2%. For non-Hispanic white consumers, down 1.6%. For Asian consumers, down 4.9%. Those are the Commission's numbers in the Commission's own report to Congress. The same report tested the obvious explanation that the score is quietly standing in for race. It measured that proxy effect and found it small, about 1.1% and 0.7% on a second measure. Comparable, the Commission noted, to other rating variables already in common use. So the score is not mainly a proxy, it is something harder to name. And the Commission was direct about that too. There is not sufficient evidence to judge which of these explanations, if any, is correct. The regulator found that it predicts. The regulator pointedly did not find that it explains, which is the strongest version of the industry's case, and it deserves a straight hearing. If the score genuinely predicts claims, then banning it should break something. Prices should get less accurate, good risks should get overcharged, and the market should show strain. That is a real test, and there is evidence on it. The FTC ran the comparison against states that do not permit the practice using residual market share, the share of drivers who cannot get a policy in the normal market, as the strain indicator. The pattern it found is nearly identical. Its conclusion on the scores: they at least did not interfere with the market functioning. Hawaii has banned the practice by statute. In the NAIC's 2023 expenditure data, the average Hawaiian auto premium was $888.07 against $1,281.60 countrywide. The NAIC itself cautions against reading state comparisons as cause and effect, and that caution holds here. It is an existence proof, not a mechanism. A state can ban the score and still have a low-cost market. The cleanest test is the most recent. In 2021, Washington State banned credit in auto rating. A National Bureau of Economic Research paper published this February measured what happened. The relationship between credit and premium compressed by roughly 70%. Insurers, the authors found, cannot easily reproduce the predictor from the other factors they are allowed to use. The market kept operating. So the verdict is narrower than either side wants. The score is defensible as predictive. It is not defensible as necessary, which leaves the question of what a premium built the other way looks like. There is one, and it has been running since 1988. California's Insurance Code, Section 1861.02. It does not merely permit rating factors, it ranks them and requires that rates be determined by them, in the statute's own phrase, in decreasing order of importance. First, the driving safety record. Second, miles driven annually. Third, years of driving experience. Credit is not fourth. Credit is not on the list at all. So the belief is not wrong. In California, it is written into law that a premium must be the price of a driving record. Everywhere else, the ranking is sealed. The false assumption is not a misunderstanding. It is a correct description of one state. Tenth of a cent. The value nobody counts.